Yesterday, the US markets took a hit. I lost some too. So what's going on? Are we entering a bear market? Is the artificial intelligence bubble about to burst? Are there really big problems in the American economy? I want to talk about all of this with you. I know you're right in your criticisms. I can't make videos very often, but at least I want to make videos on these critical turning points. Unfortunately, most of the forum is currently reserved for our school members. Every day I'm trying to develop new products and services for them on the AI side, and we're also keeping an eye on the markets and looking at stocks. Most of my attention goes there, but still, I think we need to take a look at the market today, because I'm sure many of you are worried. All right, now let's get to what's happening with the American stock market. How much longer could these declines last? Are we at a critical point? Let's try to understand all of this together. Yesterday, the Nasdaq dropped by 2.21%, the S&P 500 dropped by 1.44%. The Dow Jones was calmer. Small cap stocks were a bit more stable. The VIX also went up, but closed the day at 19. You know, as long as the VIX stays below 20, I don't get overly worried about the stock markets. There are a few reasons that triggered yesterday's decline. The first is the Kospi. Kospi is the index of a South Korean stock exchange. There was a sharp drop there. Yesterday, they fell by around 10%. Today, it recovered part of that loss. There are a few reasons behind the drop. One of them, which I initially thought was the main reason yesterday, but later realized it wasn't the real issue, is a report published by Bank of America. Bank of America says that a bubble is formed in the South Korean market. And to some extent, they're right. South Korean activity involves heavy leverage, and this sometimes inflates the market quickly. That may have triggered the drop. Also, reports say some South Korean officials plan to tax stock market gains. That likely caused the stock market to drop a bit. It had risen very quickly since the start of the year or over the last 6 months. There's been a 106% increase in the index, so it's perfectly normal for it to have a correction from time to time. So what did this do? It ended up hitting the American stock market. Stock markets are interconnected in many ways. For example, someone who traded in the South Korean market might also have spot shares in the American stock market. When they take a loss on the other side, if their margin gets called, they might have to come and sell their shares here. This is especially true for large funds. And when a big panic atmosphere spreads, what we call a sympathy trade happens in many other places too, meaning the drop over there gets reflected here as well. The main factor driving up the South Korean market is memory stocks. Artificial intelligence, memory stocks. Samsung and SK Hynix are among the stocks that have really driven up that market. When they drop, America's Micron also falls on this side. As you know, Micron is one of the rare stocks that has recently been pulling the stock market toward Korea. When it drops, all the stock markets start tumbling down. And on days like this, of course, there are always people on social media who immediately start talking about how artificial intelligence is collapsed or is finished. There are also those who instantly start making comparisons to the past. Look, it was just like this during the 2000 crisis. We're experiencing the same crash, and so on. They just fueled a panic atmosphere. Then, when stop losses kick in, the declines can multiply. On days like this, the flow of bad news keeps coming. In fact, yesterday, Bank of America released yet another piece of news that hit the American stock market. They did an analysis. They say that inflation will remain high until the end of the year. The Federal Reserve might raise interest rates 3 times. 3 times. Not once, not twice, but 3 times. This again became a good excuse for selling in the stock market. Because as you know, raising interest rates both slows down the economy and messes up valuation multiples. It's a 0% chance. Why is it a 0% chance? I tweeted a few things about this day. Let's focus on that a bit. Then let's get into the macro situation in America. Why is inflation rising in America? Lately, it's because of energy prices. What's the source of the problem with energy prices? What's happening in the Strait of Hormuz? So does this affect long-term investors' expectations about inflation? Because remember, the American central bank tries to manage expectations. If expectations are that inflation will rise excessively, everyone raises their prices. Price movements get distorted. That's why they try to manage expectations. So let's look at what the latest expectations are. We can see this from the 2-year yields. The 2-year inflation expectations are at 2.05. This is called the break-even rate, the 2-year break-even. In other words, we can say this is an outcome, a derivative of transactions in the Treasury securities market. Those who trade in the Treasury securities market are basically saying, I see inflation at 2%, and I want to earn a premium on top of that from Treasury securities transactions. So this isn't the result of a survey. This is an outcome that emerges from actual Treasury securities transactions. They see inflation at 2% for 2 years from now. Hold on, it gets even better. If you ask what the one-year inflation expectations are, they see that expectation of 1.6%. So by the end of next year, market players see inflation at 1.6% or 1.69%. What does this mean? The market has no concerns about inflation at all. Why is Bank of America publishing a report like this? Honestly, I don't know. Either they're doing a really bad analysis or they want the market to drop. Actually, last week, Bank of America published a report claiming that a sharp drop was coming to the American stock market. But instead of a drop, the market went up. I don't want to accuse anyone unfairly, but maybe they said something just to trigger that drop. So the expectations for future inflation are actually quite low. There's nothing to worry about here. The main reason for this is what's happening in the energy sector. As I'm preparing this video, oil has dropped to $72.52. The sharp decline is continuing. It's about to dip below $70, and this is gradually being reflected in pump prices. It doesn't get reflected at the same speed. It takes a bit more time. But as you can see at the pump, the price per gallon is $3.75. This is the average for America. It varies a bit from state to state. Right now, it's dropped to $2.9. In the latest inflation report, the main trigger for inflation seemed to be just energy. It may take some time for these drops to be reflected in inflation. On Thursday this week, the PCE inflation index will be released. That might come in a bit high again, so we need to pay special attention to that. But if energy prices keep rolling down like this, it will definitely end up being reflected in inflation sooner or later. Plus, who is currently heading the central bank in America? Right now, it's Kevin Ward. Kevin Ward is someone directly appointed by Trump. At last week's central bank meeting, he said, "We will continue to fight inflation." But the old methods aren't working very well. They'll find new methods. And in this context, he set up 5 separate task forces. This task force is re-examining where the Fed gets its inflation data from, all its assumptions about inflation, basically questioning everything. Do you know what this really means in practice? We're going to start seeing reports in a month or two suggesting that inflation is actually lower than it appears, and some indicators will change and so on. And we will definitely keep hearing statements that inflation is going down. In this situation, especially with someone appointed by Trump at the head of the Federal Reserve, I honestly see it as impossible for them to raise interest rates again. But of course, you never know. This is the stock market after all. Generally, I've been someone who's been right about inflation in the stock market. Those who have been following me for a while already know this. I see the possibility of 3 interest rate hikes by the end of this year as 0. So if the main issue behind yesterday's declines is South Korea, I don't find that meaningful. Although there's leverage in the US as well, the drop there isn't as steep. But this could be triggered for a while. If the reason behind it is that inflation in the US will stay high and therefore interest rates will rise, I think that's just nonsense. So what could be a third reason? The issues related to artificial intelligence and the price movements in AI stocks are well known. Especially the memory sector is going really strong this year. That's why the market is looking for a reason to attack AI stocks. Some stock prices have risen a bit too quickly. So I find some corrections to be normal, but the reasons being put forward for this are almost comical. Yesterday, the most talked about topic was that token prices are falling. In this case, big language models like Claude, OpenAI, Grok, and Google Gemini can't make money. This will eventually hit the market. What does token mean? A token is the output of artificial intelligence. So if you're using AI in any way, whenever you want to do something, it spends a token. Apparently, there's been a decline in the prices of these tokens, and this supposedly signals how bad things are going to get in AI. You know, I always love numbers. I don't like acting based on these kinds of assumptions. That's why we added a special section to our platform that we share with our members. This special section is called AI Pulse. In other words, the pulse of artificial intelligence. We're trying to understand what's happening in this market, but when I say we're trying to understand what's happening, we're not just looking at stocks. We're really trying to see what's actually happening. I'd like to share this special section with you. You won't really find this kind of data from other content creators. The table below measures the changes in rental prices of the most heavily used microchips in AI right now, the GPUs, specifically NVIDIA GPUs. So, what's in here? There are H100s. These are older generation chips, as you know. There are H200s. These are the chips that are heavily used right now. There are B200s. They're being used intensively at the moment. Soon, the B300s will start coming online. These are bought by large data centers. Then they let others use them for artificial intelligence. There's been an increase in rental prices for all of them. For example, the price for B200s has gone up by 3.2% just in the last week. Right now, if you want to use a B200 GPU for an hour, you pay $6.12 in rental fees. That's 3.12% higher than a week ago, 11.6% higher than a month ago, and 11% higher than 3 months ago. What's the situation with the H200s? Compared to a week ago, the price has increased by 2%, in a month by 9.6%, and in the last 3 months by 18.2%. Even with the oldest chips, the H100 chips, when we look at them, there's been a 14% increase over the last 3 months. So that means there's more and more GPU usage. What does that mean? It means people are doing more work in artificial intelligence. Now, let's get to the heart of the claim. The claim is that token prices are dropping. And that's actually true. When we look at token prices, it's at 7.63, which means it's dropped about 4% in the last 30 days. So in that case, Google, Claude, and OpenAI are about to go bankrupt. The AI game is about to collapse. I don't know if nobody checks how things are calculated, if people just don't like to look at the details, or if they just want to stir up the market. Here's what's actually happening. Yes, there's a decrease in token prices, but there's an increase in token usage. Unfortunately, there isn't a place that produces daily data about the increase in token usage to feed their own AI every day. But I read all of Claude's and OpenAI's statements, and they all show incredible increases in token consumption. What does this mean? Yeah, the price is going down a bit, and that's actually a good thing. Thanks to this, we can consume more tokens and get more work done. As someone who uses AI actively, I'm very happy about this. But this doesn't decrease these companies' revenue. On the contrary, it actually increases it. Why? Because we're using more tokens. This is something that happens with every new technology. And that's exactly how it should be. The unit cost of the product needs to go down so that more people can use it and companies can make more money from higher volume. What's happening right now is actually just that simple. There's a 4.5% drop in this index. This is called the token compute spread. What does that mean? Compared to the previous month or 30 days ago, when we look at it, AI large language models are making a bit less money per token from the GPUs they use. But does the total amount of money they make change? There's no concrete data about this. We only know that Claude's revenue is constantly increasing, and the revenue projections are also continuously going up. That's something we know for sure. The same goes for OpenAI. But it's not possible to measure this concretely right now. I mean, we don't get data about this every day. But what do? They take a single piece of information from here. They say the token prices have gone down. In this case, the AI game is dying. Guys, honestly, I don't want to be insulting, but these are examples of low intelligence that I just can't wrap my head around. Token prices can go down. This happens with all new technologies. The big players try to lower the price of the technology so that more people will use it. And actually, they're also creating a kind of dependency here. Here, what we call harness features come into play. So it doesn't really matter what the AI language model is. What's important are the usage features of that language model. For example, Claude has features like skills, for instance. Thanks to these features, people use it so intensively that they don't want to leave. That way it keeps me hooked. The CEO of OpenAI has already said something like this. If we want to hook big organizations as well, we need to keep token prices low for now so we can get them in, and then they won't be able to leave. Now, developers and coders can quickly switch between these kinds of large language models. But people like me, whose background isn't in software, but who are trying to build, maintain, grow, and develop software like what you see on the screen, once we get used to something, we don't leave it easily. Only a small portion of employees at large organizations are developers. Most of them aren't. So what does OpenAI do? They're targeting those people. The story is actually that simple. But here, people are making a huge fuss about it. I don't believe any of this fuss at all. All AI companies have increasing expectations for revenue and profitability in the future. Look, here's the earnings transformation table. Just like in our analysis, there are upward revisions. Who was getting into these core GPU companies? Companies like NVIDIA, core plus networking companies like Augur, memory companies like Micron, core GPU companies like AMD, and core custom designed chip and data center companies like Marvell. All of them are trending upward. The universe average. In other words, there are upward revisions in future revenue expectations for all these AI companies. So this isn't exactly true either, but these doubts will keep getting brought up and put in front of us. Why? Because there are those who are left outside the AI radiation zone. There are also those who will profit from its decline. And then there are also those who really don't understand this, don't believe in it, or just have the wrong idea about it. Now, friends, the AI game's still going on, but I'm not saying that stock prices won't fall. They'll go down, they'll go up. For example, today Micron's earnings report is coming out. After the US stock market closes, Micron is one of the most hyped stocks of recent times. You know, it's one of the biggest players in the memory game. After the earnings report, it could go down or up. We can't know that, but the big story in artificial intelligence is still going strong. Investments in this area are accelerating incredibly. There's no problem at all, but they'll keep cooking it up and serving it to us. So, is there anything fundamental in the American economy that could make the declines in these stocks and indexes permanent? Let's take a look at that too. Then we'll move on to the technical side of things. It's also worth correcting myself here. Declines can continue and corrections can deepen. The American stock market frequently experiences corrections between 10 and 20%. It's expected to see at least 1 or 2 10% corrections each year. Yesterday's correction in the S&P 500 wasn't even 2%. These are possible, but is there really anything happening in the American economy that could stretch these declines over a long period and push us into a deep bear market? I want to take a look at this. For that, we have another great report, Macro. Here, we look at America's macro data on a daily basis. We keep track of everything that's happening, holding all the indicators in our hands. First, let's look at the interest rates and dollar panel. There's nothing too unusual on the interest rate side. It's not great. Interest rates are high. We want them to go down. But one of the things we look at here, for example, is SOFR rates. SOFR means what's the situation with the loans that banks give to each other. There's no problem. We don't see any issues here. Another thing we look at is the 10-year, 2-year yield spread. You know, if this spread turns negative, it's a sign of recession. That's not the case for us right now. There's no problem with the 10-year, 3-month yield spread either. The 1-year real interest rate is still positive. So yes, interest rates aren't great. Everyone would like to see these rates go down, but we don't see any signs of recession on the interest rate side. Let's move on to the inflation side. We talked about this at length earlier. Inflation's unpleasant and some inflation data is high. But I think this is basically due to energy. I believe that starting next month, the drop in energy prices will be reflected at the pump, and from there, in inflation. I also believe this is a temporary issue. So, how's growth going? Growth is going really, really well. The Atlanta Fed announced a 3.4% growth expectation for the second quarter. Both the ISM manufacturing and ISM services indices are above 50. They're at 54 and 54.5. We can see that there's growth here. S&P Global Manufacturing and S&P Global Services are at 55 and 51.3 respectively. Both are above 50. It looks positive. There's no problem here. The ISM Services Prices Index and ISM Manufacturing Prices Index, these are problematic when inflation is high. I hope it will improve. As I mentioned earlier, retail sales are extremely strong. There was a 1% month-on-month increase. We don't have any issues. The weekly economic activity and the strong economic surprises index are positive. This is an index I calculated myself. So there are positive things in the main criteria affecting the American economy. Is there anything negative? This is also positive. There's no problem here either. I mentioned this a little earlier. The 5-year break-even is currently at 2.18%. There's no problem there either. So we don't see any break in inflation expectations for the future. Are there any issues on the consumer side or in the labor force? There's absolutely no problem on the labor force side. Unemployment's coming in at quite reasonable levels. We don't see any major issues in the latest unemployment data. It's stable, neither trending up nor down. So there's no problem on this front either. When we look at sectoral health, the housing sector is problematic here. In other words, this area is trouble because mortgage rates are high. It's holding back economic growth a bit. But I still don't see any major problems in other areas. I have a special risk and recession panel that I developed myself. And here too, there's nothing indicating a major risk or a recession. For example, the VIX is pretty calm in contango, so it's given the right impression. Are there any extreme movements in the MOVE index for American bonds? No, there aren't. There's nothing on that side either. There's no problem like the yield curves we talked about earlier. And at the same time, fear still dominates the markets. For example, when we look at the CNN Fear and Greed Index, it shows 28. This indicates there's extreme fear. We like fear because fear means that a lot of investors are staying away from the market. So guys, fundamentally, there's no problem in the American economy. There may be declines, stocks might go down. This happens due to technical reasons or because of profit taking. Right now, as you know, we're heading into the end of the month and the quarter. Some large investment firms might feel the need to readjust their positions. There may be declines, but will this turn into a very persistent long-term drop? The economy tells us that's not the case. There's only the risk of inflation. And as I said, I think that's a risk that'll be resolved in the coming months. So how do the markets look technically? So there are some unpleasant things there. One of them is that the big players in the options market are currently negative gamma. Technically, I won't go into the explanation of this. We have extensive reports and trainings about these topics. Come and sign up for school. Watch all of them. We talk about this every day here. We even have a report just about options and option pulls here. It's published every day. There are also trainings included in it. There are daily trainings every day, so we can understand the world of options. What does negative gamma mean? Big option sellers are currently moving in the same direction as the market. So if the market falls, they're selling too. If the market goes up, they're buying too. This makes the movements both up and down more intense. We actually saw an example of this yesterday. In other words, a move that could have been handled much more moderately was amplified even more because of this negative gamma. Because option players also had to move with the market to protect themselves. When we move into positive gamma, the opposite happens. Let me not get too deep into that right now. Technically speaking, there's pressure on the stock market at the moment. Why? Because yesterday, the Nasdaq index fell below its 50-day moving average. QQQ, which I'll show in a moment, broke an important upward trend line to the downside. Well, on the S&P 500 side, the 50-day moving averages are also being tested. SPY is at a critical spot, sitting right on its 50-day MA, while above the 200-day, it's broken below the 10 and 21-day lines. Similarly, the QQQ has dropped below both its 10 and 20-day averages. It's heading toward the 50-day. Also, if we look at it from this angle, we see that the Nasdaq, or QQQ, broke an important upward support line yesterday and closed below it. These aren't good signs. To be honest, there seems to be a bit of trouble on the technical side. Could this technical issue get worse? It could. First, both the Nasdaq and the S&P 500 might test the 50-day and could dip below from there. Since things on the option side aren't looking too healthy either, it seems like we have a risk here. On the other hand, again, this is an important point from our report. RSP has diverged from the S&P 500. What is RSP, Nick? RSP is the equal-weighted S&P 500. The equal-weighted S&P 500 barely dropped at all yesterday. It only declined by 0.34%. Look, you can see it here. So what does this mean? Yes, the main indexes are falling because there was quite a bit of selling yesterday in the big tech companies that usually drive the indexes upward. Especially Micron. That messes up all the indexes. But actually, there isn't that much unrest underneath. On the contrary, there's rotation happening. In other words, money is flowing into other areas. Of course, this could change, but what's happening right now is a bit of a shift away from riskier assets. At least, that's what happened yesterday. There's a move toward less risky sectors like XLP, XLV, and XLU. In a way, that's actually a good thing. It helps calm the market down a bit. We're already heading into the summer months. Market activity usually slows down a bit during the summer. But actually, there wasn't a total crash yesterday. Even though things look bad when you look at the indexes, the situation is much, much better in equal-weighted terms. The side that crashed yesterday was tech stocks because of artificial intelligence. I don't know if that drop will recover today. Today, Micron's earnings report is coming out. Tomorrow, the PCE data will be released, so we'll see what happens there. But to sum up, there isn't really much behind the reasons given for the declines. I don't see any problems there. Not with inflation or AI, but technically, are markets in a correction mood? Yes, they are. Could this correction deepen a bit more? Deepen? For the market to get out of this correction mood, Micron needs to deliver a really good earnings report today, and the market needs to like it so that tech stocks can go up. And tomorrow, the PCE inflation data needs to come in well organized. If these don't turn out well, lower levels could be tested. In this regard, in the report here, I also provide all the support and resistance levels for each stock, as well as for all the main index ETFs and main indices regarding what we can expect and how far things could go. As I said, if you can become a school member, you'll see all of this. That's the situation. Here, we block out the noise and focus on our work. I always try to be realistic. Right now, there's nothing on the fundamental side that could disrupt the American economy. There's nothing on the fundamental side that could disrupt artificial intelligence either. But on the technical side, the stock markets are in a bit of an unpleasant spot. The movements could deepen a bit more. But I don't expect a lasting crash from here. That's the situation. Stay with love, stay with respect. See you soon, friends.